Good morning, everyone. This is Corey Hinkle with your Ankerstar Wealth Daily Update. We're going to hit on those JP Morgan earnings from yesterday. We're going to look at what Powell said yesterday, which sent the market higher. And I'm also going to address something that I've heard multiple times, which is people referencing this new book by Andrew Ross Sorkin, I believe, called 1929, where he's just documenting, getting close to the 100-year anniversary of the 1929 crash. And he mentioned in an interview on 60 Minutes that there's some overlap between now and then. So I'm going to address that in this video. But first, I need to remind everyone, this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com. And of course, the opinions expressed are mine and mine alone. All right, jumping into a market update. We've got the markets up about 1/3% right now, so up nicely on the day on the S&P 500. Technology is leading the way higher. Again, this is the AI rally. I'm not going to be speaking to that today, but that's where a lot of the growth has been 2023, 2024, and even into 2025. Lots of other sectors have kind of been left behind to some extent in that development as things have played out. Okay, JP Morgan earnings. This company is really firing on all cylinders. They are the poster child for big banks. They are the biggest bank. Their CEO, Jamie Dimon, he is the voice, the biggest voice in the room when it comes to banking and really, in his kind of view, risk management in the sector, in the space. So their earnings were amazing. Coming down here, it's almost hard to imagine, right? But they earned $14 billion, 14.5-ish billion dollars in the quarter on revenues that grew about 10%, almost some double-digit revenue growth there. When you go and look at these earnings results, hold on, I lost my slide here, but I wanted to show you these different sections. Look where this revenue was coming from. So you have banking and wealth management, home lending, card services, and automotive. Hold on. What am I missing? This is the wrong slide. My apologies. Okay. Investment banking revenue, payments, lending. You've got fixed income markets, equity markets, and securities services. They're really doing amazing work in every category of business that they do. So, it's kind of important in times like this. I know sometimes we look for what's wrong, but let's recognize what's right. These businesses are firing on all cylinders, and many of the other banks, their reports look very similar. So it's not like one company is executing. It's the sector and really, more broadly, the economy. Things are holding up really well for those companies. And here you can see those revenues there. So by segment. You add on to that what Jerome Powell said yesterday, that the Federal Reserve will stop shrinking their balance sheet. So what does that mean? The Federal Reserve holds government debt on their balance sheet. So you think bonds, just for example, right? As these bonds mature, they kind of receive payment from the government or their principal back, principal and interest. They have a few options that they can do. They can write that off. So they can shrink their balance sheet so that disappears. When that disappears, they're draining liquidity, draining money from the system. That's what they've been doing. And he suggested yesterday that they're looking to stop that. So that's going to be slowing, potentially stopping in the near future. When that happens, what that means is when those bonds that they hold on their balance sheet mature, they're actually going to go out and use that money, the proceeds, to buy additional bonds. So they're not expanding their balance sheet, so to speak. Sometimes they do that, but they are not shrinking it anymore either. They are no longer draining liquidity. When they do that, when they take that money and go buy bonds, potentially longer dated bonds, you can see the 10-year yield and the 30-year yield, some of those longer dated yields start to come down because there's a new buyer in town adding additional demand into the system, pushing those yields down. That's what the market would love to see happen. So the market moved quite a bit higher yesterday on this news, moving higher again today. You know, there's always multiple things going on in an economy at one time. This is just one more feather in that bullish cap, whereas, you know, there are some concerns still out there, and not really going down that rabbit hole today. Just want to mention that it's not like things are perfect in every corner, but they never are in an economy, right? But things are very good, and we recognize that. Okay, yesterday fielded a couple of questions from various clients, so thank you for reaching out to ask about this. But Andrew Ross Sorkin's releasing his book called 1929. I think it's like 1929 exclamation mark. And it highlights the bubble that occurred in the late 1920s. Now, this wasn't necessarily one group. The railroads were certainly in a significant bubble at this time. The railroads at that time made up about 12 to 13% of the index of the market, we'll say. And their valuations were very, very stretched. Andrew Ross Sorkin, in an interview, I think with 60 Minutes, he hinted at the idea that there's some overlap between 1929 and today, potentially hinting that we're in a massive bubble that could pop. And that could be a scary thing to hear. So I wanted to just address that. So first off, what was the main driver? And I don't know if I have a chart here, but the market went up something like 400% in a few short years prior to the bubble popping in 1929. So people were looking good for a while. During that time, for the very first time, investors, retail investors, and banks, I guess, decided that allowing people to borrow money to invest was okay. It was approved. It was, you know, approved from a regulatory standpoint, and it was implemented. Now, here's where the problem is, because people can still borrow money today to buy stocks. But back then, they would allow you to only put 10% down. So if you had $100, you could buy $1,000 worth of stock. And many people were doing this. So they were investing 10x their deposit base to try to accelerate those gains that they were going to hopefully get. Today, and I don't know what portion of the market was propped up on debt. I'm not sure then. But today, the amount of margin that's in like the S&P 500 is less than 2% of the S&P 500. Something like 1.5%, a little more than 1.5%. So is there a lot of leverage driving stock prices right now? There is not. There's not. Back then there was. So when things started going in the wrong direction, people were getting 100% wiped out in a very short amount of time. And then, of course, that back then, and even still today, you know, you could get these runs, right? You'd get a run on the bank or a run on the market, and it would cascade lower. Now, that's not the only thing that happened, though, because the valuations were completely ridiculous. The 9 largest, let me make sure I'm sharing the right screen. The 9 largest railroads, remember, that was kind of the bubble at the time, somewhat. They were trading at 53 times earnings. We're not even half of that at the index level right now. They talked about the banks. Let me see. What did they say about the banks? The banks were trading 30 times per share. So 30 times earnings, I'm sorry. And I believe that was on average. So some even much higher than that. If you look at the banks today, I think JP Morgan is trading again at a very premium valuation compared to what it's been in recent years. It's at 15 times earnings. Now, what you have to remember is when things are good, so this was also peak earnings. So as the earnings peaked, the valuations peaked as well. These earnings started to fall because things started going more poorly for the banks, for some of the railroads. The economy slowed significantly. So as earnings for these companies started to fall, their valuation multiples also started to fall. So you had gone from like 53 times earnings on the railroads at high earnings to probably something like 10 times earnings at the bottom on smaller earnings. And that's how you can get things to fall 90%. Now, what if we're nowhere near those valuations today, right? But let's just say hypothetically we were in a bubble today, and there were bubbly assets. There certainly are some. There's some zero revenue companies trading for 20, $30 billion market caps. We've seen the Palantir trading at 100 plus times sales, not looking like they're going to be able to grow their revenue fast enough to catch that, to help shareholders in that sense. The company itself will be fine. But you look at where we are today, you can identify these things, and trades are free. Trades are free, so you don't have to own them. If there's something that's just highly speculative, you don't have to own it. You can own things that are much less speculative. They mention in here that oil stocks were trading. Let me see, where's the oil thing? I read it, but the oil stocks were trading something at like 17 times earnings, which is maybe elevated depending on how they were performing at the time, but certainly not a bubble. So people owning those stocks, if they weren't borrowing money to do it, were probably fine. So, you don't have to own the things that are highly speculative if you don't want to. Of course, some people do. They want to pursue that aggressive outlook. But for those who aren't as aggressive, it can be easy to sidestep some of these things just by selecting assets that fit your risk tolerance. So anyway, hey, if you have any other questions that I didn't answer in this, please let me know. I hope everyone has a wonderful day, and I look forward to seeing you tomorrow.